Hey everyone, I'm David Finz, and on this episode of the Cyber Insurance Imperative, we're taking another look at financial institutions, since they're increasingly finding themselves in the crosshairs of regulators. So we're going to take a deep dive into the recent consent order between the New York State Department of Financial Services, or DFS, and a prominent title insurance company, because it serves as a cautionary tale for other entities in terms of the level of cybersecurity they need to have in place. Now, for the uninitiated, insurance companies doing business in New York State are subject to a set of standards known as Part 500, or the cybersecurity regulation, and these standards are enforced by the DFS. The cybersecurity regulation is meant to protect consumer data, mandate security controls, and ensure timely reporting of cyber incidents. Two of the standards contained in the cybersecurity regulation were at issue in this case. One standard requires covered entities to conduct a risk assessment that results in the development of cybersecurity policies around data governance, access controls, and identity management. These policies should be updated as necessary to reflect changes in the entity's risk profile. The other standard requires covered entities to limit user access privileges to systems that hold non-public information, or NPI, and to encrypt NPI both in transit and at rest. In this case, the title insurance company had developed a proprietary application that allowed parties to access images of documents related to their real estate transaction. In 2014, the company added a function that permitted its employees to create hyperlinks to these images. The problem was that the link generated by the app could be accessed by anyone without any type of login or authentication, and even though employees were instructed not to use the hyperlinks to transmit NPI, there were no controls in place that prevented users from doing so. Fast forward to 2019, when a reporter published an article calling attention to this vulnerability, which potentially exposed hundreds of millions of documents to the public. These documents, some of which dated back to 2003, contained a treasure trove of NPI, including social security numbers, driver's licenses, tax records, and bank account information. It didn't take much for an end user to alter their search to access other users' information. In response, the title company shut down external access to the hyperlink. They notified affected parties of the vulnerability and offered them credit monitoring. The title company also notified DFS of the vulnerability, as they were required to do under Part 500. That should have been the end of the matter, but it turns out that it wasn't. Upon further investigation, the DFS discovered that the title company had become aware of the vulnerability 5 months prior to the reporter's article. The vulnerability had been identified as part of a routine pen test, and the company's cyber defense team issued a report indicating that the vulnerability needed to be addressed, and I quote, as soon as possible. However, no further investigation or review of the vulnerability was conducted by senior management. The DFS found that the title company's failure to implement reasonable access controls contributed to the potential unauthorized access of NPI. The consent order notes that the title company had plenty of policies and procedures in place to prevent this sort of thing from happening, but they didn't put them into practice. Their access controls proved insufficient to keep unauthorized users from having access to NPI. As a result, the title company ended up with a $1 million penalty for which they were expressly prohibited from seeking an insurance recovery, and also agreed to a series of remedial and compliance measures. The DFS noted that the title company's cooperation throughout the course of the investigation, and they applauded their ongoing efforts to rectify the shortcomings in security that led to this event. Now, this investigation underscores the importance of not just conducting risk assessments, but putting into practice the procedures that result from them. You can have the best cybersecurity policies in the world, but if you don't implement them, they're not worth the paper they're printed on. And implementing them entails a combination of technical safeguards and creating a culture within the workforce that prioritizes data protection and cybersecurity. Our cyber risk consulting team is available to take you through this process and develop action items that you can take to improve your cyber readiness. To arrange for a consultation with our team, you can DM me on LinkedIn or email me at david.finz@alliant.com. And you don't even need to be a current client of ours to arrange for this separate fee engagement. One last point, insurance is important, but as you can see from this case, it doesn't cover everything. Here, the title company is expressly forbidden from using the proceeds of an insurance policy to offset the penalty imposed by DFS, and the costs of complying with the remedial measures are likely not covered either. This is why it's so important to maintain good cyber hygiene and where our cyber risk consulting team can help. Because here at Alliant, we are not just about the insurance transaction. We are fully committed to helping you find the more rewarding way to manage risk. Thanks for watching.